One of the largest U.S. companies announced plans to execute a 4-for-1 stock split, and I have several clients that own that stock, and they've asked me, is this actually good for them as the shareholders? Today I want to share with you what a stock split is. A stock split is when a corporation divides its existing shares into multiple shares. Companies choose to split their shares so they can lower the current stock price to make it more attractive for the average investor. By lowering the price of the stock, it also creates more liquidity for those existing shares. What I'm referring to here is called human psychology. Most investors are comfortable purchasing shares in round lots of 100 shares at a time. In other words, they are more comfortable buying 100 shares of a $40 stock than to buy 10 shares of a $400 stock. Oftentimes, when a company's share price has risen substantially, it may declare a stock split to reduce the price to a more popular trading range. Even though the number of shares outstanding increases during a stock split, the total dollar value of the shares remain the same compared to the pre-split because the split does not add any real value. For example, a stock may split 2-for-1, or it may split 3-for-1, or 4-for-1, etc. A 2-for-1 stock split means that for every 1 share held by an investor, they will then own 2 shares. In other words, the number of shares outstanding in the market will double, but the price of the share after the 2-for-1 split will be reduced by 50%. This is why the company's overall value measured by market capitalization remains the same. For example, if an investor owns 100 shares of a $50 stock and the total value is $5,000 and they receive a 2-for-1 split, after the split they will own 200 shares at $25, giving the same overall value of $5,000. According to research from NASDAQ, splits between 2012 and 2018 for the S&P 500 companies rose 5% in the year following the split, of which 2.5% was immediately following the announcement. Despite the advantages mentioned above, current companies appear to be giving up the shareholder-friendly practice of splitting their shares. According to a report from Charles Schwab, about 41% of stocks in the S&P 500 currently trade above $100 per share. And just 3 companies this year have indicated that they plan to initiate share splits compared to 102 companies that split their shares back in 1997. Whether your stock splits or not, the end result is the value of your overall shares still remains the same.